Hello. Welcome back to Alpha Beta Soup, where we unpack Bitcoin using on-chain analysis. I'm TXMC. Well, we've got a couple of things to talk about today. We'll look at the Bitcoin price chart, we'll look at the futures market, and we'll check out some on-chain data. I'd like to talk about what I'm seeing, whether I think that we have a short squeeze still in play in the futures market, and then I'll also talk to you guys about what we're seeing in the growth of Bitcoin the last couple of years, and why I believe some of that can explain why price has been relatively contained to this region for the past year, rather than continuing to rip as many people expected. We will discuss all of these things, so I hope you're comfortable. If you enjoy my content, make sure to give this video a thumbs up, and if you're not already subscribed, do that too. If you enable the bell icon, you'll be alerted to all of my new videos the moment they come out. Our channel is growing fast, and I appreciate all of the support. But let's talk about Bitcoin. So here we are with the price chart, and just in terms of raw price, there isn't a whole lot to talk about that has changed. We're still looking for support along the low of the previous liquidation. And as our analysis has shown, the last few times we've talked about this on this channel, we're still quite range bound in a year-long area for price, and we're dead in the center of it. So there's a lot of eyes just kind of waiting for a direction to be established, for Bitcoin to resume its trending nature. And even if we look here at some of the resistance that we've been toying with as we've done our price analysis in recent videos, we can see just how clearly centered we are in this range of price. Now, it is nice that we were able to see buying support step in here at this wick that tested the 40K level. In the previous video, we talked about the positives of seeing buy volume step in at a crucial level like this. So for now, that is a positive. And while it's too early to say that the reversal is in, this was a great place to see some volume, to see some demand show up. And now we could continue ranging sideways for a while. I mean, you can see how price has a tendency to just kind of get locked in a range for a period of time. That's not uncommon. And for me, that's okay. I think the place to really hold support is this red line right here that I've drawn, which matches the low wick from middle September and also the bottom of the recent wick we were just talking about. That level right now is 39,600. So while I don't make price targets and my focus on this channel is not price itself, I do have an invalidation for my expectations. And right now my invalidation is that level. So if we were to sustain a price below this level, my expectation would then become price would make its way down to the bottom of the range, and we would have to test the July and June lows of last year. Nobody wants that. So let's check in with our futures dashboard and see what's going on with derivatives. Here we've got open interest for the perpetual market at the top of the screen. On the left, it's in US dollar terms, and on the right, it's in BTC terms, raw Bitcoin. Now, I did field a lot of comments since the last newsletter for Glassnode that I put out a week ago, where a lot of people were confused that their version of open interest didn't look like mine from the newsletter. I'll leave a link to that newsletter in the description if you'd like to see the written content we're putting out at Glassnode. It's completely free to everyone, so check it out. It's in the description. And my chart from that newsletter was open interest in Bitcoin terms. But a lot of people see open interest here in USD terms, which looks quite different, and it led to a lot of questions. So just make sure that when you're looking at open interest, you're looking at the denomination you expect. The BTC on the right, USD on the left. I look at BTC denomination because it removes the impact of price changes on the value of open interest. So in USD terms, when the price drops 20%, the value of the open interest drops 20%. And I can't always tell if the fall in open interest is because of the price change or because people actually closed their positions. So that's why it's good to look at OI, both in this term and in BTC. I hope that clears that up. And the observation here is that OI is still extremely high. It's basically still at all-time highs after recently setting a true all-time high. It's pulled back a bit, but it's still very elevated. And what do you know? Look at these little red pockets on the funding rate. Beautiful. Let me zoom in. The futures perpetual funding rate demonstrates the bias in the futures market. It helps to govern the premium rate that brings balance to the futures market. When there are a lot of aggressive longs, the premium spikes up. And in those instances, traders who are long, who are betting on price to go up, have to pay a premium to traders taking the short side. It's a way of encouraging balance and for charging traders for taking on risk. What we've been looking for the last few months was to see funding eventually go negative, which would help to confirm a great existence of shorts in the market as we've expected there would be. Now, Binance and some other exchanges will clamp their funding rate to a positive value of 0.01% when there isn't enough aggressive bias to shove it beyond that. There's a certain boundary of funding where if it's within a certain percentage up or down from this level, it automatically defaults it to 0.01. So when people see this positive funding rate like we've had the last few weeks, a lot of folks take that interpretation to mean there's a bunch of longs because funding is positive, but it isn't really positive. 0.01% is not a positive funding rate. It's a neutral funding rate. And the fact that the funding rate is a little below this value. See, here, this is where 0.01% is, where my cursor is. But the funding rate has been below it ever since the liquidation on December 4th. And that is because of the existence of short traders. There's enough short traders in there creating a gravity on the funding rate, which is helping to pull it down, but not enough to cause a complete imbalance and create a negative funding rate until recently. Now, some of that could be because as price has been negative and very ugly, some of the short traders that did exist here, because some of them are here all the time, might have closed out their positions, causing the balance of funding to tip to the negative. The other side of that coin is that we could have seen even more shorts stepping in at this level. That's also possible. And when we look up here at open interest in Bitcoin terms, and we see that it's still very high, and even the decline in recent days has been a muted decline. It's very possible we're now seeing shorts taking the mantle of aggression in futures. And when we've got really high open interest and we now have a negative funding rate, if it stays like this, it opens the door for the short squeeze scenario that we described in the previous video. Now, whenever I put out videos talking about a short squeeze, inevitably there are people who are disappointed when it doesn't happen within a day or two. But please understand, I'm not predicting a time frame. I am simply pointing out that the ingredients, the climate in the market is one that is favorable to a short squeeze. That's the way to think about this. So we've got high open interest, which means there's a lot of contracts sitting open in futures, a bunch of traders with positions open. We see the funding rate negative, which tells us that the bias is tipping to the short side, which means the shorts are being more aggressive. And because of the clamp on the funding rate that I described, where a minimal amount of bias will keep it at 0.01, the fact that we're seeing it this negative, there is a palpable imbalance to the short side because this funding rate went negative on its own through the behavior of traders, rather than this event on December 4th, where the funding went negative as a result of the liquidation. These cascading closures that pushed the futures price so far below the premium index that it created a negative funding rate. This is almost like a momentum play, like a roller coaster that went too far down. Over here, this is the organic development of shorts building up and overpowering longs. So this is a different dynamic from December 4th, and it sets up the possibility that if we actually do get the reversal that we talked about over here, if this is a reversal, then the setup for a short squeeze is obvious and could be dramatic, at least enough to get us out of this range and perhaps start creating some new highs for 2022. We'll have to see. But the converse of this is that if we do not get the reversal, if price shows additional weakness, if there's more sell-off, well, we've got a bunch of traders that are biased towards that outcome, and they will be on the winning side. I say all of this to simply point out that we're still in a very uncertain place in terms of price and derivatives. We'll look at a bit of the Onchain metrics in just a moment, but from a pure price action and technical and derivatives perspective, we are looking, we are observing, we're waiting for a trend to be established. Bitcoin is a massive trending beast, and once we can establish a direction for that trend, it can help set up our expectations for the coming weeks. So I did want to look at long-term holders this morning because I've been curious if their activity has changed at all as price has pulled back now into the low 40s. You know, we had a lot of people who bought at the top. There always are a lot of holders that buy at the top. And we still have other holders who bought the top in the spring. And both of these groups are now underwater. The group from the spring are now long-term holders, and this group from October and November are still short-term holders. But we've got a lot of people with supply from higher prices. And I've been curious if the weakness we've been seeing and all the macro uncertainty and the hawkishness from the Fed have caused any behaviors to change. Well, for long-term holders, it's business as usual. The long-term holder supply is still horizontal, and it looks like it's curling upwards. Yep, if I look here at the 30-day change of long-term holder supply, which is what we call long-term holder net position change, rolling 30 days. Look at this. Look at the green bars. We've got accumulation by this group. In the last few days, it looks like net accumulation really began in late December here. We see we got a lot of spending and then it just stops. And now we've got net accumulation by this group all the way through January, net accumulation. So that's a huge positive. If we zoom out and we see here, net accumulation tends to happen when price is pulling back, when there's weakness. And long-term holders like to spend into new highs when we create new prices. That's what they did in November. But as we've pointed out on this channel, as we've observed, the spending out of long-term holder supply in October and November was only a fraction of what they've spent before. And now that we're seeing this accumulation here again, it's really reinforcing that the way we look at long-term holders, the way that we lay out our expectations for this group are very accurate, and they tend to behave in reliable and trustworthy ways. They accumulate in weakness, they spend at high prices. And the reason it's important for us to watch long-term holder supply, as we've talked about on this channel, is because they own over 70% of Bitcoin. So we need to watch and see when this group begins to distribute, because it can very easily turn the market over. But right now, nothing but accumulation. We'll also briefly check in here with illiquid supply. So we've talked about illiquid supply and illiquid supply shock on this channel numerous times. That was actually in the very first video for this channel going back to September. Now, illiquid supply represents hodlers on chain that have a very low history of spending, as we've talked about at length on this channel. And it's one of the core metrics that helps us to determine the strength of the hodler class and the trend of accumulation on chain. Now, illiquid supply is this group here with the blue chart in the center of the screen. The raw supply is in the background, and the little green and red bars that you can kind of see down below are the net change in this metric. When it's red, the group is losing supply. When these little bars are green, it's gaining supply. And while it may be hard to see, these green bars have permeated the last couple of months for illiquid supply. Look, it's just growing and growing, even accelerating its rate of growth. So what this is showing is that Bitcoin is ending up in the hands of on-chain entities that have a low history of selling, of spending their coins. And that's occurring while price is pulling back from the all-time high. I'll zoom in even further. So since we created the all-time high in October and then November and pulled back, illiquid supply is just going up, 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 up. Now, it is important to point out that illiquid supply has a slight bias towards new investors, towards new addresses. Some traders, some Bitcoin users create a new address for every withdrawal. Not all of them, but there is a growing culture of creating new addresses for each transaction. There is a lot of address reuse that still goes on as well. But whenever a user withdraws to a brand new address that's never been used before, that address, by the nature of its definition, is illiquid because it has one transaction and it's a withdrawal and there's no spending. Whenever there is a Bitcoiner that pulls coins out of an exchange, for example, and it goes to a brand new address, that address shows up as illiquid supply, even if that user for their lifetime has a large history of spending tied to other addresses. So there can be a little bit of noise in illiquid supply if you try to get really granular looking at certain types of users. But when you look at it in the aggregate, it still represents a trend. And over time, as we get further away from the present moment, the algorithms that we use to cluster addresses and identify entities on chain will get smarter. And if that user causes one of those new addresses to interact with any other address that has a history, and our algorithms recognize it as a certain behavior, they will then get linked as an entity and we will know their history. Now, with all of that explained, we can still glean insights from illiquid supply. We can still use the macro trend in conjunction with other factors and other data points to assess the market. It's never in a vacuum. And what we can see here is illiquid supply has been growing. There's been a few little bumps in the road, but most of the time it has been growing since the summer, or since May and June rather. Because I know there are people in the other half of the world for whom May and June is a winter month. So I shouldn't say spring and summer, I should say May and June. May and June is where we had heavy distribution by illiquid supply, and there's been a few pockets of distribution. You can see these little pink bars, but mostly they've been growing their supply, and they have now almost just as much as they had when they started distributing in the spring, though not quite as much. Similar to what we pointed out with long-term holders who are now net accumulating after their textbook distribution at the top, though it was more limited. We're also seeing illiquid supply growing, supply ending up with entities and addresses that have a low history of spending. So these are positives, while we're seeing highly liquid supply, which is the converse of illiquid, continuing to reduce, now hanging out near multi-year lows for highly liquid supply. Now, highly liquid does contain exchanges, but it also contains other intermediaries, other day traders, and things like that. So the fact that we're seeing this balance continually reducing while illiquid supply continues growing, to me, is very positive, and it helps to set up the climate, the environment for Bitcoin to be friendly to a spike in demand, because that's what Onchain is showing us. It's showing us the supply side of the equation, and price and markets are made between supply and demand. So when I describe a supply squeeze in Onchain, when I say that hodlers are sucking up supply, exchanges are seeing less and less coins available to new buyers, long-term holders are stacking coins, those kinds of things are creating an environment of supply where if we were to get a sudden surge in buyers, price would react very favorably. I explain all of this about liquid and illiquid supply because I want to set the expectation for how Onchain should be interpreted. I see a misnomer often on Twitter and in other social media where I see folks who describe conditions using Onchain analysis, and then the expectation becomes, well, if you're describing market conditions, price needs to react immediately because you're saying that there's a supply squeeze. You're saying the hodlers took all the Bitcoin. That's not exactly how it works. Onchain is describing one half of what creates a market. A market is really made by two forces. It's a pendulum in between the forces of supply and demand that are constantly at war with each other. And while one side of the equation, the supply side, is described in detail using Onchain data, the demand side is more nebulous and unpredictable because it wavers from day to day and it depends on who shows up in the market to buy Bitcoin that day. But we can use on-chain data and historical outcomes to lay out frameworks of probabilities that describe outcomes we can look forward to if certain criteria are met. So when we look at illiquid supply growing the way that it is, we can say supply is being restricted and going into the hands of strong-handed hodlers, people with a low history of buying. Highly liquid supply, the supply that describes exchanges and traders and intermediaries, is seeing a lower and lower portion of supply. We're also seeing accumulation from long-term holders after a limited amount of spending at the highs. So all of these conditions are laying out a friendly climate to where Bitcoin would react very favorably if demand suddenly increased. And that's my current assessment of the market. The squeeze continues, but demand remains very low and inconsistent. And it's almost impossible to predict demand. So we have to continue monitoring the supply side and wait for signal that demand could be increasing. And all this that we're talking about today with supply and demand, with on-chain and with expectations for Bitcoin, bring me to what I'd really like to discuss. And it's related to the realized cap. So the realized cap is this orange line here, and it's the absolute foundational metric of current on-chain analysis. It is one of the core data points that we base a lot of our interpretations on. Now, the market cap shown here in this black line is the total sticker price of all Bitcoin. It's the current market price times the total circulating supply. If there was a theoretical buyer who wanted to buy the entirety of Bitcoin in one transaction, they would pay the market cap price. The realized cap is the price of every Bitcoin when it last moved on chain on the base layer. And in a sense, it's a proxy for the amount of value, the amount of money that is stored in the Bitcoin network. Every time a coin changes hands, it is repriced, and that price is reflected in the realized cap. When you see rises in the realized cap, that is showing you that many coins are being repriced from lower prices to higher prices. And the realized cap, in a sense, is like the cost basis of the network. So when you see moments where the market cap dips below the realized cap, like it did in March of 2020, and like it did here in late 2018 and early 2019, in these moments, the network as a whole is in loss. Most of the coins have moved at a price higher than the current price, which means that the supply is underwater. Those represent typically generational buying opportunities. But that's not why I wanted to talk about the realized cap. I wanted to talk about the realized cap because of how much it has grown and how I feel that that impacts Bitcoin, and partly, in my estimation, why Bitcoin has been trapped in a certain boxed range for the last year. And it's an economic explanation. So as we described, the realized cap is the value stored on chain. And when it moves up, when it's rising, it's signifying capital inflows and coins being repriced higher. From April 2020 to May 2021, the realized cap grew over 270%. From 101 billion up to 378 billion. And then again, from May to December of last year, it grew another about 24%, up to 464 billion. That means that from April 2020 to December of last year, there was $363 billion of supply spent to new hands, in tandem with price itself rising over 600%, about 660%. That scale of coin repricing takes a long time to digest. It takes time for all of the participants in this market to reestablish fair value. A market for any asset is really just a nucleus in between the two forces of supply and demand. When we create a bull market, demand drives us to new highs. When we reach the top of the market, it's because supply then creates overhead resistance and puts on the brakes. It takes over dominance. And when you have a climate like now, where the demand itself is very inconsistent, as we've talked about, but we have ready supply. There's coins on the exchange right now for you to go buy them. When we have ready supply and inconsistent demand, price naturally tends to gravitate toward an equilibrium point, toward a support point, and that tends to be sideways and downward in a low demand environment. The price itself is really just the outcome of many thousands, many millions of investors that each manage their own biases. They're all managing their risk and reward. They're trying to minimize risk and maximize gain. When you have a dramatic repricing like this, from 100 billion up to 464 billion, even just this from April to May, just from 100 to 377, that kind of dramatic repricing, the scale of that repricing, means that the market needs time. The human beings that make up this market need time to find balance in this new playground for price, to rediscover what risk and reward looks like in this new area. Because let's remember, a $30,000, a $40,000 price for Bitcoin, those are relatively new concepts. Before the beginning of last year, those prices were unheard of. And no matter how much Bitcoin gets taken off the exchanges, gets put into the hands of illiquid types of hodlers, no matter how much is gone into long-term holder supply, what actually makes a market at the end of the day, a free market like Bitcoin is ultimately the seeking of balance between risk and reward. And unless an external factor comes in to disrupt the signal, like macro headwinds, unless there's some external factor like that, simple supply and demand will take their time. They are tectonic forces. And when you have $363 billion worth of newly transferred Bitcoin from April of 2020 until the end of last year, that size of repricing, that scale of change and growth requires time. It might need a few months for the dust to settle. I think there was a big expectation that since Bitcoin made this parabola and then pulled back 50%, there were people looking back at like the 2013 and 14 market. Here, let me zoom out. There were people looking back at this 2013 and 14 market thinking, oh, we made this first parabola. We must certainly be going in for a second one. Maybe that ends up playing out at some point. But right now, we're still in this playground for price right here. And it's coming on the back of this massive rise in the realized cap. Just look at this orange line underneath. This is the repricing of supply, and it more than tripled in a year and a half from April 2020 until last month. The next time that Bitcoin moons and the realized cap grows another several hundred billions of dollars, this process is going to start over again in a new boundary for price, and the balance will be sought again. Risk and reward will need to be reestablished in the aggregate minds of the millions of people who hold Bitcoin. And once it is, price will show us that outcome. Because price is just the end result of millions of people making decisions in their own best interest. When you've got this kind of repricing, this scale of change, it takes time. Sometimes it takes months. Sometimes it takes a couple of years, as it has in past markets. It takes time to readjust to the new boundaries. So I think that that's partly what we're seeing. I think that it helps to explain in a way why Bitcoin has gone sideways since April or May of last year. It doesn't explain everything, but it's a perspective that I think is valuable to keep in mind when we're assessing the markets. So as we discussed, Bitcoin is still ranging and, in my estimation, is still in a sense recovering from the epic repricing of supply that occurred in 2020 during the massive bull run we had. And while we still see long-term holders net accumulating, and we see illiquid supply growing at the same pace it has, helping to set up the potential for a squeeze scenario if we get a spike in demand, we still have open interest cranked up very high, basically all-time highs in Bitcoin terms for the perpetual market, which is where this funding rate exists, and we're now seeing negative funding, which shows us that the shorts have finally taken over control. We're seeing all this high open interest while we've got negative funding. Just the tiniest amount of positive price action might make these traders extremely uncomfortable, and that's something I plan to watch coming into next week. But for any trader who's looking at medium or longer time frames, the risk reward right now is just not very good. We're in the dead center of a year-long range. And until we have a clearer picture of the bias, either to the short or the long side, in my estimation, it's a time for patience. So that's what I wanted to talk about today. I want to really discuss the realized cap and how much Bitcoin has grown in the last year. It's been on my mind recently. And if you have any questions about that or you have feedback for me, please leave them in the comments. Make sure you're following me on Twitter right here at TXMC Trades. You should know by now that I post a lot of charts and analysis, and I'm very active on Twitter. So if you ask me questions, I try my best to answer as many as I see. We will give the market a couple of days. We'll check back in early in the week and see if things are playing out any differently. We might have some other things to talk about then as well. I do plan to do a live stream in the near future. I just need to get the software set up and test it out. But we will continue making these videos no matter what we do with the live streams. I hope you're all having a great weekend. Mine has been very relaxing. I've just been hanging out at home with the family. And I hope you've found time for yourselves as well. We'll chat in a couple of days. Take care of yourselves, friends. Be kind to one another. We'll chat soon. Cheers.